What's happening, Hardscapers? This is episode 247 of the How to Hardscape podcast, where we talk about how you can start and grow your hardscaping business. And on today's episode, we have another Cycle CPA podcast takeover episode. And Cycle CPA has been an amazing supporter of the How to Hardscape podcast now for more than 2 years. So I just want to say thank you to Cycle CPA for being a supporter, a sponsor of the How to Hardscape podcast. And if anybody's looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. I highly recommend them. They've actually done some content for us in our members area for our software, and that was the Knowing Your Numbers course. And there's 2 modules in there, the profit and loss statement module and the balance sheet module, and they just go through each of those statements and walk you through what they mean for your business. So in addition to a couple of interviews that we've done on the podcast, a webinar that we've done in the past, and also their takeovers, a few takeovers now of the podcast, I cannot highly recommend them enough. Great people, Joseph and Carla over there, as well as their team. But not only that, also getting into that they specialize in this industry, in the green industry in general. But this gives them an ability to be able to give us or their clients industry-specific benchmarks, industry-specific analysis through our numbers and recommendations. So they really have their finger on the pulse of this industry, which I think is extremely crucial when it comes to looking for that bookkeeper accountant, especially if you're looking for that CFO in your business. Then you'd want somebody that actually knows our industry. And just getting into today's takeover episode, Joseph talks about a few things that I took notes on here. Building inefficiencies that come with growth into the budget. So this specific episode has to do with growth and the risk that comes with growth. Building those inefficiencies that come with that growth into our budget helps us to remain profitable through those tough times of growth, and build those into our quotes that are actually going out to our clients. And I'm a big advocate of that as well. Divisional P&Ls, profit and loss statements, so that you know how each of the different divisions are doing in your business is really important. It also helps you identify those most profitable services and double down on those, especially in a time when you need to focus on profit. Overhead salaries seem to make up about 9.3% of a company's revenue. So in that case, we're not talking about the field labor salaries or hourly wages. We're talking specifically office, admin, whatever that might be for overhead salaries, making up about 9.3%. And then the benefit of having at least 2 times fixed monthly cash reserves in your business. Just a few notes that I took myself listening to this episode before I actually publish it, but I'm sure there'll be many others. And if you find any others, shoot me a message, things that actually stand out to you, or shoot Cycle CPA a message on Instagram at cycle_CPA, and definitely get that conversation started to get our finances in order coming into 2024 here. As I look out the window right now, sun is out, there's no snow on the ground. Really weird for this time of year, and who knows, we may be into a March early start here coming into this season, which I have never in my time in business, even working at the supplier, don't remember a time where I actually started a season in March. Unprecedented, some would say, but definitely a time that we can kind of capitalize on that early start to make a little bit more income for our business coming into the season here. So without further ado, let's get into today's episode with Joseph from Cycle CPA.
Hey everyone, Joe Policastro here with Cycle CPA. Looking forward to diving into some financial topics here and taking over the How to Hardscape podcast. Really as we're kind of starting off 2024, want to start by looking at 2023, right? And seeing, okay, what are some things we could potentially learn from what happened, and coming up with a plan, right? Coming up with a plan this year to hit the profits that you want to hit, and, create a company that's really financially healthy, right? And one of the first things to consider, right? And there's a lot of distractions out there, a lot of different things that you can get involved with. You can add on 100 different service lines. You can, there's a lot of different things that can ultimately take your attention away from what are the core issues or what are the bottlenecks, right? That are actually preventing your company from being profitable or being financially healthy. Because oftentimes, adding on another service line or trying to go into another market or, you know, other items like that, typically you're still going to need to solve some of those bottlenecks, right? Whether it's recruiting or other aspects that are preventing you from growing, and make sure that as you're planning for the new year, that you're allocating the proper resources and energy into solving those bottlenecks. The other thing is prioritize the main drivers of revenue and cost, right? And when you're looking at a service-based company, it's labor, right? That's ultimately what's going to drive revenue and profitability in the company, and it's also your largest cost. So yes, you can dive into the weeds, and you could try to lower your insurance costs, or you can try to see, okay, what is the least possible amount I can spend on this given item. But at the end of the day, focus on the items, right, that are going to have the biggest impact on the company's financial health. And typically when you first started your company, right, almost think about it in those terms and think about how every single dollar counted, right? And you made sure that when you were setting up your company that you were doing it in a profitable way, right? That you were going to be getting a return on investment based on the certain decisions you were going to make. Now, sometimes as a company grows, it can almost become easier to get complacent, right? Or let inefficiencies exist because you're making a profit anyway, right? And it's important to stay close to the operations and have an understanding of some of those items, because you want to catch things before they do become an issue, right? Before it does become a cash flow bottleneck, or before you see someone in the office or in the administrative side of the business not handling things as efficient as they should, right? And so it's important to look at some of these things earlier on, right? And ultimately, even if you already are maybe past the 7-figure mark and as a business owner, as you're looking to make additional moves, make sure that you're ultimately going to get a financial reward for some of those moves, especially if you're continuing to grow the company. Because a company that is, let's say, 2 million in revenue, there's certain risk and there's certain and there's more energy that's just involved with operating that business. So you want to make sure that you're making a profit of a $2 million company, not the profit of a $500,000 company. So, and what I challenge everyone out there is to, shoot for a healthy profit margin, at least 15 to 20%. Because it's definitely something you can hit, and we have many clients that are hitting that within the landscape and hardscape space. Now, even just based on some of the data we have internally, based on our landscape install and hardscape install based companies, they grew by around 14% in 2023, right? And some of the things to consider, right, when you're growing is you're going to need to look deeper into the financials, right? And even more consistently and more frequently, because with growth, there's more risk, right? And some of the other risk items that you have to consider, right? Because that's ultimately something that, from a financial perspective, almost like you would have a COO or someone head of operations, companies have a CFO, right? And for small businesses, maybe like a fractional CFO, which is something we can help with, or just more from the advisory perspective, right? And one of the biggest things as you're planning out for the future, right, as you're planning for 2024, ultimately you want to manage risk, right? And one of the things is making sure you have a good cash reserve, right? So typically we recommend having 2 times fixed monthly expenses, and what that helps with is it not only helps to manage risk, but it also allows you to stay in the offense, right? So you're operating this profitable company. So now if an opportunity arises, you can you can move on it, right? Instead of being in the position where, you're more in the defense, right? And you can't ultimately take advantage of some of those opportunities because you're more worried about just covering some of those upcoming debt payments. Another thing to focus on when it comes to risk is client concentration, right? So do any of your clients make up more than 10% of your revenue? Right? So that's something to look into. And if you do more project-based work where you are working with larger projects, understand that, yes, you may have some projects that make up more than 10% of your revenue, right? Because it's not necessarily like a recurring business model like maybe some maintenance companies are, but there's a certain risk to that, right? So for instance, if you have a contract with the property to do some of the maintenance services, that revenue for the year might not be as much rather than doing a project that's maybe $100,000. So with that larger project is more risk, and that's where it makes even more sense to make sure you have job costing and you have some sort of feedback loop where you can see, okay, how did we execute on this project, right? And carrying those patterns and using that data now for 2024 to really narrow down into, okay, what are the specific jobs that we can do profitably this year. Also looking at credit risk, right? So are you extending credit to your clients? If so, increase the amount of the upfront payment percentage-wise. So maybe you only took a certain amount, maybe 30%, and it never hurts to ask for more, right? Sometimes we see contractors, they kind of think that there's a certain number that their market will take, but ultimately, you should, not let those kind of decisions be based just off your theory or what you hear. It should be more based off of what your customers are saying. And are they giving pushback? Because if they're not, then there's area of opportunity there. And then also implement favorable progress payments when it comes to frequency, right? So maybe you only took 2 progress payments. Maybe, push that to 3 or 4, right? To really help with your cash flow. Because it's one thing having a profitable company, but if you're not managing different items like this that impact your cash flow, it could be just as bad as, ultimately not even pricing out a job for a profit. So definitely prioritize that. Also, liquidity risk, right? So will your business be able to convert some of its assets, like its accounts receivable, like some of the money that's owed to you and some of the cash, in case there's a need for those, funds to be used, right? And that's basically what liquidity is. It's the ability to basically keep up with some of those debt payments. And this is also a big thing, right? And some of you, it's even most common with companies that have a little bit of maintenance or recurring services. Make sure that you don't have any loss leaders. This is an industry where, it's very labor intensive. There's a lot of time and energy that goes into running a hardscape company, right? And even if you run kind of like that landscape maintenance or lawn care aspect to it, or any reoccurring aspect, right? You want to pay special attention to any potential loss leaders, right? And making sure that each division within the company is profitable. Another way to look at risk, right, is making sure that you're diversified. And I think what a lot of people think of initially when you think about diversification is, oh, what's another service line we can add? But it's also within your business, right? So looking a little bit deeper. Now, when it comes to, for instance, marketing, right? So do we have multiple marketing platforms and strategies? And you may have the most success using a specific strategy, but ultimately you don't want to be overly reliant just on that one specific strategy, because there might be a little tweak, maybe in the Facebook algorithm, or maybe it's at a certain job fair that happens every year, but they end up skipping it that this year. So make sure that you're diversified in things like the recruiting, and marketing, or subcontractors. Maybe you work with a key subcontractor, and that's where 95% of your work comes from. That's fantastic. But if you plan on growing the company, I would plan and put effort into, trying to work with other subcontractors in the area, or build other relationships where work is flowing through in that way. Also, material suppliers, right? Is there some sort of diversification you can make with that, right? And what this really comes down to, and almost similarly to if you look at some of the employees within your company, you want to set up some redundancies, right? And you want to make sure that if one aspect of your company gets slightly changed, that it's not going to basically take down that whole department or process. So it's always something you want to look into. And then learning from the past, and I know I touched on it briefly, right? So it's kind of looking at 2023 and looking at the numbers. And this is something that we cover, with our clients, is we can even see down to like your net cash flow for each given month, almost in a trend format. But you could basically look at, okay, what months did we experience low cash levels, right? And strategize on different things you could do to basically counter that for the next year. What are last year's one-off costs that you don't expect to incur in 2023? And what are some of the trends of some of the major financial metrics, right? When you're looking at things like your gross margin or your net margin, right? And seeing, okay, what is impacting those, and what are some strategies we can take to improve those for the next year. Also looking at, is there a specific service line, location, or department that is worth scaling, right? Because it's operating well, versus others where it may not be as much worth it to kind of continue to scale, right? And again, using your numbers to basically guide those decisions is something we would definitely recommend. And when you're looking at making projections, you could take into account a couple of different things, right? You can look at some of the market factors, take into account your current growth rate. You can also build in some assumptions and some goals, right? But you want to be, it's better to be conservative, and I think it's great for companies that are looking to continue to grow, even in an aggressive way. But ultimately, that needs to be backed with data and confidence that you can support that growth, right? So if you're looking to grow by 100% next year or 50%, it's just going to increase the speed to your bottlenecks, right? So do you have the recruiting system set up needed for that? Do you have the marketing? Do you have the labor? Do you have the training process? So all things to consider. Because if you put yourself in a situation where you think you're going to hit a certain revenue number and you don't want to, you want to be careful in increasing some of your fixed costs as you make maybe that aggressive growth rate, because that's something we see sometimes, right? And ultimately, you want to make sure that over time, if there is revenue growth, that your expenses are not growing at a faster rate, right? And that's with your direct costs, right? Like your materials and field labor, but also your overhead as well. Your overhead expenses, all those back-end administrative expenses, those should not be increasing at a faster rate than your revenue. And at certain points, you may need to, hire a key person in the office to support some of the growth. But just understand, again, going back to risk, that just increases risk, right? And that makes it even just more important that you do hit those revenue goals. Also, some things to consider when you're making some projections is, looking at some of the historical data, right? And that's ultimately what you can guide those projections based on. And then also contracts or projects that are already in the pipeline, right? So using all this information to really think about, what that sales projection is going to look like for next year. And if you have the ability and there's ways within QuickBooks or within the accounting software that you use to separate your divisions, right? And almost have a separate profit and loss statement, right? That shows your income and expenses for each division. And ways you can do this is you can have each division or employee have a different credit card, right? So you kind of know, okay, these given expenses are for this division, these are for this other division. Also, a technique we use with some clients is the receipts will be labeled for whichever division it should be allocated toward, right? And there's a way even within QuickBooks to track those divisions by class, which is the function within QuickBooks. But every software should have that basic capability as well. And part of that is, again, kind of even going back to what department is worth scaling, right? And within the green industry, or even if you look at hardscape companies and you may have a certain division that you provide a different kind of service, there could be different business models even within the green industry as a whole. So it's important to look at some of these divisions separately, right? Especially as the company increases in size. We work with some companies that are below 500,000 in revenue, where it could get a little counterproductive if you're trying to separate divisions in a situation like that, just because there's a lot of employees doing a lot of different kind of divisions at once, and it could be a little more difficult to separate. But as a company grows, then it makes even more sense to make sure that you're looking at a profit and loss for each division. And then even when you run payroll, making that allocation to each division as well. So you really, again, you have a clear picture of what that profit and loss is for each. And then, one of the biggest things when it comes to planning for next year is thinking about your staffing budget, right? And a good technique is to understand, okay, what is the revenue per field labor employee that we should be hitting, right? Typically, within the install-based services, and I think even the industry median based on our internal data this year was around 15% of revenue, right? So, if you have $100,000 worth of revenue, 15,000 of that could be allocated toward paying an employee, right? So understanding that, if you pay an employee, let's say 45,000, you have 300,000 as a bucket, roughly to, be able to support that. And if you're going to hire people ahead of time, make sure that you have the data to back that up. And when I say ahead of time, that means if you don't have all the revenue to support that. And an example is, for instance, again, going back to some of the data that we have for overhead salaries. So that's all of the administrative team members, all of the management, sales, basically anyone who's not actually physically touching the work in the field. That should be around, I think last year in 2023 was around 9.3% of total revenue, right? So now you may be, let's say, $1 million company, and your overhead salaries may be a little bit higher than 9.3%, but your goal this year might be to hit 1.5 million, right? So and the hope is that ultimately that employee is going to be able to kind of fill up their capacity as they get to that $1.5 million mark. So and then also putting a lot of emphasis into training and developing talent, right? Especially in a labor market where it may be hard to find candidates. Put an emphasis on things that you could control, right? Training is something you control. So maybe you can find people that have a little bit less technical skills, right? But double down on the training. Also, are you going to offer additional benefits? Make sure that you're building that into your budget. Are you going to be subcontracting less, or are you going to use more in-house employees? Be sure you're making, and also when it comes to work that you're doing as a business owner, make sure that you're paying yourself a salary for that. And each entity structure has a different, kind of from a compliance perspective, a different way that you should be doing that. So definitely consult with your accountant. But in general, you want to make sure that you are paying yourself for, whether you're taking out in draws or whether you're paying yourself a salary, like for instance in an S corporation. And then also matching your team members' roles with the appropriate tasks, right? So if you have especially within the office, right? If you have an office management level person, making sure that they're not doing, kind of basic data entry work, because if they are doing mostly basic data entry work, then you maybe didn't need almost an office management level person. Maybe you just needed more of an administrative assistant, right? So, and that goes along with a lot of other roles within the company. And as you scale the company, you might see specific team members being bogged down by more and more, work that, kind of that, some of that data entry work, for instance. But that's why it's important to continually monitor the workflow and make sure that you're really getting the best use of, someone's time there. And, and there's also such thing as being understaffed, right? So it's good to see overhead being low, right? But at the certain time, you don't want to add additional stress to your team, right? Because that may, decrease employee retention, right? And it may even be more of a barrier for your company to kind of continue to grow. So it is healthy to have, a good amount of people on the team, right? And I think, especially when you mix that with the right technology and software as well. And also, when it comes to staffing, thinking about capacity planning as well. And one of the biggest items, especially within this industry, right, when there's a lot of seasonality to it, we see a lot of companies that try their best to retain team members during the slow season, which is great, right? But ultimately, you need to keep in mind a couple of things, right? Basically, if you are going to do that, you're going to need to make sure to look at your financials on a yearly basis, so those profits that you're making, right, in the busy season, you need to make sure that that's enough to basically carry you over, right? Or you might think about adding a different service line, right? Now, one of the biggest things with capacity planning is also understanding that you can ultimately find ways to replace some of your fixed costs with more variable costs. And an example of this is you may have a team of 10 people, right? But you know that when you scale down for the winter, you can only retain 7 people. So instead of having 10 full-time employees, maybe you could have the 7 full-time year-round, and then the 3 subcontractors year-round that are more flexible, right? Where when you do enter the slow time, you're not having to pay as much of a fixed cost. So that's an example, right? And also things like having more of a flexible marketing spend. So it's great to have, maybe an agency helping out or something like that, but ways that you can ultimately lower spend on marketing in certain parts of the year. And then also looking at things like renting equipment, right? Especially if you're not utilizing certain equipment to its best ability, so that you're not stuck with maybe some of those payments year round. Having some administrative staff work remotely, right? So it's thinking about different ways to really lower those fixed costs. Another thing when it comes to planning is looking at the pricing strategy, right? So it's good to have an understanding of what the market pricing is, but you don't want to box yourself in, right? And put yourself in a position where you're kind of putting that limit on yourself, right? Let the customers ultimately make that decision, right? Let your close rate guide that decision, right? And what I always challenge companies to do is, if you're in the position where you're almost trying to make it work at all costs with this potential customer to get that job, because you're afraid that if you don't get the job, then you're not going to be able to support your team and make payroll. Try to, instead of being in that mode, put yourself in a position where you're putting more of an investment into marketing and advertising and sales and trying to build relationships in the community, where you could be in a position more in the offense, where you have more opportunities, and thus you could be a little bit more picky and work with the jobs that are going to ultimately pay you for what you guys are worth there, right? And the value that you're putting out there, especially in hardscape based work, especially if you're doing beautiful work and outdoor living, items within the backyard. So there's a lot of value, and really utilize that within your selling process, and make sure within your pricing there's certain expenses that are more of just pass through expenses, right? So yes, you are buying this material, but in essence, the customer's paying for that. So make sure that the customer is paying for that, and you're not the one that's paying for that. And then there may also be an opportunity where you can change your payment structures Whether you implement different contracts or subscription-based model. And oftentimes you can even, use that as an opportunity to maybe do an upsell, right? Or build in a slight price increase. And especially as we're talking about planning right now and budgeting for 2024, make sure that if you are going to have changes in the company, that you build in the expected inefficiencies and delays that come with ramping up any changes that are going to be happening in the company, right? If you'll implement something at the beginning of the month, understand that depending on what it is, it's going to take time, right? So again, it's good to be optimistic, but in a certain way, you have to be realistic with certain aspects, especially when you're planning, like the sales goals, for instance. And then also making sure that you're utilizing your team when it comes to planning, right? These are the people that are doing the work in the field. These are the people that are experiencing some of the workflows within the office. You want to make them part of the decision making, which is ultimately going to make them buy in more to the processes that are being created within the company. And these are just a couple things to kind of consider as you're planning for 2024. I think one of the last things I'll kind of leave you guys with is, I think that, oftentimes, you can kind of look at different moves within the company or just kind of look at where the company's been the past few years and think that, okay, that's kind of how it's going to be moving to the future. But I think from the perspective, especially as I speak with, a lot of companies within the landscape and hardscape space throughout the year, there are companies that do very well, right? And they are able to hit profits, right? So, I think it also takes a change of mindset, and you can kind of get very granular into a lot of the numbers and a lot of the financials, which is something we do with our clients. But, I think at the end of the day, it takes action, it takes a good plan, and, I hope that some of these tips help you, moving into 2024, and and I wish you all a profitable year.
Thank you for listening to today's podcast episode. Reach out to Cycle CPA on Instagram at cycle_CPA. Let them know that you listened. Let them know that you enjoyed it if you did, and any notes that you have. I would also appreciate any notes that you got from this episode, and anything that you'd want to hear more from Cycle CPA in a future episode. Shoot them a message. Shoot me a message at How to Hardscape on Instagram. Them Cycle_CPA on Instagram. And once again, if you're looking for that bookkeeping, accounting, CFO services, cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. And we look forward to meeting with you next week on the How to Hardscape podcast.